our structured value strategy involves using puts as a tool to purchase stock for below market prices. And you've all been very patient. I'm gonna now show you exactly how we're able to apply the structured value to a special situation during this unique period of uncertainty and volatility that's going on through the pandemic. Internally, we refer to this position with the admittedly awkward name structured dividend capture, but that is exactly what it involves. We consider the basket of stocks that are in this space as one portfolio position. So through extensive research, we've identified some secure businesses that are paying high dividends and also have abnormally high option premiums, meaning we are paid a lot to purchase the stock. And if we're paid a lot to purchase the stock and then paid a high dividend and then paid a lot to sell our shares via a covered call, which is the inverse of a cash secured put, we can make a significant percentage-based return over a relatively short period of time. So again, we treat the basket of opportunities in this space as one position, one holding in the portfolio. And as you'll see, we're rotating capital through these holdings. So this is going to get a bit complex. So I'm just going to jump right into it with an example. Just remember, we are basically finding solid businesses with exceptionally large dividend payments that we can capture using our structured dividend methods. So allow me to explain via this example. This example shows what happens with Kinder Morgan, one of the largest energy infrastructure companies in North America. KMI is currently paying over 6% annual dividend, and that's paid quarterly. And you can see this dividend in our diagram here above the ex-dividend date as plus 1.5%. So this blue line here is a timeline moving from left to right. So in this case study, by selling a put that expires prior to the ex-dividend date, we can capture a 75-cent premium and then buy the stock for $17. We then receive a 27-cent dividend and immediately use a covered call with a 10-cent premium to exit the next week. We thus earn 3 incoming cash payments worth $1.12 over a very short time horizon. We earn 4% from the put, we earn 1.5% from the dividend, and we earn another 0.5% from the covered call, and we're back to cash. Okay, this provides us with a 6% gain in just 14 days. The astonishing annualized return of this situation is over 350% in a year. The problem, of course, is we can only do this 4 times a year. There's only 4 times that a dividend's paid. Fortunately, there are some other companies that offer this sort of yield. So let's take a look at AT&T. We see here that AT&T is paying a 7% dividend quarterly. We show that it's here actually as it's rounded up to a plus 2% dividend each quarter on the ex-dividend date. The ex-dividend date is also different than that of KMI. So if we sell a put here that expires on July 2nd and hold the shares during July 9th, we can exit with a call on July 16th and capture a 3.6%. We capture 3.6% during this 2-week period. Again, this annualized return is astonishing. It's 150% annually. But further, this is a real example, and it also illustrates the outcome where the stock price fell nearly 7% during our holding period. So we still earned 3.6% over 2 weeks when the stock declined 7%. So how good can this get? Well, here is a capital flow diagram that starts with the allocation to KMI and concludes with the allocation to AT&T. And what you see here is that by picking up each of these dividends Using the structured value purchase and sales method, we pick up 21 payments on these 7 securities, and this earns 41% in a single quarter. It's incredible. In fact, Buffett has remarked in the past that if he were only managing $1 million, he could guarantee 50% annual returns. And it's opportunities like this that make it possible. Now, not every position is going to work perfectly, but the gains are so high in this space that we can literally afford to miss a couple that don't hit the strike price of our contracts perfectly. And, you know, one might wonder, how could this anomaly exist? First of all, this won't last forever. I think there are 2 conditions that are allowing this to persist longer than expected. First, this is sufficiently sophisticated. It's a sufficiently sophisticated strategy that your typical retail investor or market participant is going to have very little success in chance of executing this successfully. But second, and more importantly, the volume in these products is too low to allow larger players to get involved. So anyone filing a 13F with the SEC would struggle to put meaningful capital through this approach. So smart money will just leave this niche space open for us, and we are very capable of making meaningful returns here. So in this situation, having a modest fund size with 15 or even 20 million under management, it becomes a huge advantage. And finally, it's worth commenting on the enormous amount of analysis that was required to reach the conclusions on this diagram. And each quarter, this capital flow diagram will look different. So don't go just putting this in place blindly. Prior to putting this in place, months of analysis were required. Identifying the initial positions of value was extraordinarily time intensive. And ultimately, I realized we needed a better solution. In fact, we needed an automated solution. So this is the flow diagram of the in-house automated solution we built to aid our analysis. So using Python, we reduced the time for analysis from months each quarter to just a few hours. The software we built gathers data from 3 different subscriber databases and creates a 13F superset. It breaks down the KPIs for us based on financial statement fundamentals. And then it identifies the ideal capital flows based on IRR parameters in excess of 100% annually. So we truly can't be sure how many more quarters we're going to be able to operate this efficiently. Certainly, the increase in uncertainty around the pandemic has delivered many more opportunities than we previously thought possible, and we have not experienced any slowdown yet. We will end this position whenever it becomes unfavorable, but in the current environment and likely into 2022 and perhaps into 2023, we will be applying this special situation to our portfolio, and it is giving us a major tailwind. Thank you. Great question.
Thanks. I love the follow-up too. To follow on that, with the structured dividend capture strategy, can you talk a bit more about the risks there? It seems the risk might be getting stuck with a stock in that interim period when you own it. Can you talk about your views on risk and how you manage that risk? And then secondly, how you choose the companies that you're using in that strategy?
Yeah, definitely. And of course, it's a pretty unique situation we've come across here. So each individual position, I know we've kind of walked through that waterfall looking Gantt chart where we're talking about the capital rolling through. We need to make like a simple way to sort of explain this, but we actually have a basket of these securities. So it's not like we're not really exposed very much to any single position. So we may have 10 or 12 that we're going through simultaneously. So each individual holding only represents like 1% of the portfolio capital. It's very small. So even if there was a position, and we've sort of normalized this and looked at stress testing different components, we expect generally to have some positions that move up a lot, some positions that fall a lot, and maybe 8 of them stay roughly, within like standard deviations of the mean expectation. So we sort of take a statistical approach to it. Any single position isn't going to do us very much harm. So the risk of, and by the way, we're holding it for such a short period of time. It's sort of interesting. Like there isn't really enough time, because we have done a little analysis, but there isn't really enough time for these firms to do something terrible to happen. But if there was a total market collapse, or something did happen, what would happen is we would end up owning a bunch of these stocks like KMI and AT&T that we really didn't intend to hold for the long term. What's interesting is that the dividend, unless they suddenly stopped, would actually become really large. And as I tried to show in the AT&T example, we actually held that during a period when the shares fell 7% and still came out up 3.6%. So a single position doesn't have much of a situation to harm us. If the whole market fell, we might own a few super high dividend paying shares. But maybe it's worth explaining. And then, Danielle, you can tell me if this is clear or not. If it does happen where we sell a call as a tool to exit the position, and sometimes the price in the market is below that strike price. And what that means, it's usually not a lot below the strike price, usually just a little below the strike price. And what that means is we then can sell another call that expires the following week. So if we're getting paid 50 cents to exit a stock that's selling for $12, and we have a $12 strike price and it's $11.59, at the end of that week, we keep the 50 cents and we still own the stock. So we just sell another one for the next week and pick up another 50 cents. And frankly, if you do that a lot, you're actually making a really good return as well. So it does happen where we have to sell calls, for a few weeks to exit positions if they're not hitting our strike prices.
Okay, great. So we just got a follow-up question in the chat asking just again what happens for that strategy if there's a severe market dislocation. I think you've answered that you would end up with some stocks that you maybe didn't intend to own.
Yeah, and I think
just expand a little.
Yeah, I think at the beginning you had also asked how these were selected. So I will hopefully this can be hopefully this will give you confidence. It gives me extreme confidence. So the selection process, the whole filter process that we're using is already throwing up really reasonable firms. So these are all companies from the 13F analysis of our favorite 100 funds in the world. So these are owned by the Seth Klarmans. These are owned by Warren Buffett. These are the firms that these folks are buying. That is our starting point. And we're looking through this list of 300 or 400 companies. And then we're overlaying all of this data that we're getting from Capital IQ. So we're downloading all of the financial data. We're looking for any companies that are overexposed, have too much leverage, have big red flags, and we just throw them out. We don't care. We look at all the companies that are having abnormally high dividends. And some of the companies we might not be interested in because they look like they have extreme volatility, and maybe we don't understand them well, and we just don't want to have it in the portfolio. So it's a process of elimination, but it's the starting point that's so important. These are owned by the super investors of the world to start with. And then we're going and we're looking for everything to cover ourselves. And then we go in and we sell these puts at strike prices, below the market price, even where we're getting paid a high premium, paid a dividend, then paid a call premium to exit. We're picking up these 6, 7, 8, 9, 10% gains in the course of 2 weeks. And because of our starting point and that we do this fundamental analysis, we're really confident that the companies we own are decent companies. I'm not saying they're the best companies in the world. They're great companies. Some of you work for these companies, okay? It's like ExxonMobil and Chevron, and it's AT&T. I mean, these are like blue chip firms. They're not going to disappear, and they're paying very high dividends, and there happen to be really high premiums right now due to all the uncertainty in the market.
One more follow-up on this structured dividend. We're getting a bunch of questions about it. Considering that the return on equities over the next 7 years is regularly forecasted to be fairly minimal, does that impact your thoughts about the structured dividend strategy? Does that change the way you've thought about it at all, or are you expecting something different out of the market?
So look, macroeconomic forecasts, everybody wants to have a crystal ball, but nobody has a crystal ball. So I don't think anybody can say some macroeconomic event will or will not occur. There are, for example, all sorts of debates about inflation going on. There's smart people on either side. The future is really unknowable. So I will answer the question, but we don't really know what's going to happen to equity prices over the next few years. That might have been a question referring to the fact that the long run average, multi-century average, is 6.8%. And that is true, 6.8% plus inflation. So does that impact? So first of all, let me address the portfolio in general. Just because the market does 6.8% plus inflation, that does not mean that we will do 6.8 plus inflation. The companies that we own, I expect to do far better than that. We are doing deep fundamental analysis, bottom up research. So we are going, we're scouring the earth for these gems that we can find that are, mispriced for whatever reason. Maybe they have things that are missing from their financial statements. Great management teams, great business models. They can do very, very well. So I expect our core portfolio of these compounders to do extremely well. The fact that interest rates are so low makes this structured dividend capture very interesting, because I expect, it's just so hard for people to earn yield in this environment. It's really interesting. It's like endowments and foundations and things. They're just going to struggle so much to get across their 7% hurdles, I think, because they have to have a bond allocation, and then you have to go way out on the risk curve to get kind of 3.5% these days. And this is like, it seems so interesting that we're able to just like print this capital. I mean, people are just paying us to buy a solid business, and then we're getting a dividend, and then they're paying us again to exit. And we're picking up these really astronomical returns. I mean, this is like, I've never seen, it's a very special time to see this. I hope it never ends, but I'm sure it will end. And I think, yeah, so the fact that returns might be lower, I don't think it impacts the structured dividend capture position at all. What it means maybe is that the firms are stable. One thing that I will say about it is, because interest rates are so low and you've got all sorts of investors of all kinds, institutional, retail, in cash, it's actually I monitor the money market flows very carefully. It's quite interesting to see that the cash, the money markets now have about twice as much cash as they had before the pandemic, which means that people are still sitting in cash, but we're seeing inflation tick up. And at some point, people will recognize that their capital is being eroded. My belief, and again, I don't have a crystal ball like anybody else, but if I were the chair of an endowment and I had to decide where to put my capital, and I'm looking at treasuries paying 1.5% and inflation at 5%, there's no way I can get away with, I can't justify, I'm going to lose purchasing power. So what I would be thinking about is, where can I capture a stable company with a good dividend? And I would be much more happy to own a bunch of these businesses that are actually in our dividend capture position, as a sort of picking up the dividend yield, and then you also have some upside potential in the stock. So I think we're in a pretty good position, and I think some of the holdings will be recognized down the road as being really good places for capital.